What's going on, everybody? It's Jeff here. Welcome back to the channel. Okay, the GameStop report came out yesterday. I was unable to make a video last night, and I wanted to take a little bit of time to digest exactly what was inside here. And I probably could have just skimmed over it and not taken the time to read it. And I'm going to go over everything about this report, why it was even written, what to look at inside of it, and where we're going to go in the future from here. So let's get right into it. First off, I want to say this. This report is 45 pages that really only focuses on probably maybe 3 or 4 pages about the actual event in January. But what they have done here is they have tried to educate us retail investors who are going to read this, okay? Try to educate us about how the market works. In no area that I found in here did they say anything about what is actually happening, okay? What is happening with executed orders and so forth. It just shows you what is supposed to be happening. And there's a couple things that stood out to me. By now, I'm sure you've already read this. I'm sure it's all over Twitter, the most important, clips of this. But I want to just talk about a few things that stood out to me, and then I'm going to give you my take on this. So first off, this right here. While customers set their terms of their orders, the retail broker-dealer generally controls where to route the order for execution, subject to best execution, which best execution is not necessarily best price. It's not to fulfill you, when you're buying an order closest to the bid as possible, and when you're selling an order closest to the ask. Best execution happens to be the quickest exchange, and also potentially one that could benefit the broker dealer the most, okay? Which is not what the fair and open markets were about when they were originally created. Next thing right here, less than 60% of overall equities volume is typically executed on exchanges. Now, I've done some research and I haven't read everything, but when off-exchange markets were created, they were originally created for block orders. So you didn't pull down the price. We've gone over this before. If somebody wants to sell, 200,000, a million, 10 million shares of a specific stock, even if the average volume is up there 20, 30 million, they're going to drag down the price a lot. And I originally agreed with this. As a retail investor, I don't want to be now invested in, Webster Bank, and all of a sudden you have a big guy that, sells a massive block and that murders my value. So I agreed with this. But for 60% to be traded on off exchanges and basically putting in here some fluff in order of how the payment for order flow works and in order to make best execution and so forth is really just a bunch of BS. Because here's the other thing that sticks out even more to me. Off-exchange market makers have more flexibility. There you go. It's like saying, where are you going to drive fast? You're going to drive fast down a highway that you know is infested with cops, or you're going to drive fast down a highway that has guardrails on both sides and you never see a police officer. It's exactly what was said to me in here. Next thing that I want to point out was this one right here. Most exchanges offer a form of payment for order flow. We knew about this for a while. They compensate these firms that provide liquidity with rebates and charge firms that take liquidity. For stocks, some exchanges have retail liquidity programs that allow special orders to interact only with designated retail orders, which may be supplemented by pricing incentives. So it seems like this is not how payment for order flow was beginning to work. It was not set to work when this was first created. And the SEC had portrayed that they were not going to basically allow this to continue to happen, so that you have so much of a beneficiary saying, listen, we're going to pay you top dollar, give us all of your orders. Okay, that becomes one-sided. That's a monopoly. Well, now they're basically saying that it's okay for it to happen. Next up, I think I got one more in here, and then I'm going to give you my entire take on this. Okay, next up was this right here. Some institutional accounts had significant short interest in GameStop prior to 2021. It had a float higher than 100%, a total of almost 123%. Then it goes into explain how this is normal, how it can be possible, and so forth. Okay? Which inevitably, it also talks about the fails to deliver and say that there was no issue, that these were all covered within a few days. Well, I want to talk now a little bit about this article, but then also talk about AMC specifically, because that's the one I've been covering the most and I'm the most invested in. And here's the thing. In no case am I surprised whatsoever that this, document, you call it, was written for pure fluff. The SEC does not have, and this is my opinion as well, does not have the backs of the retail investors, does not have the backs of the institution. Their goal is to maintain validity and credibility inside the stock market. So money flows into it. Most importantly, international money flows into it. That's what I believe their main goal is. And in order of doing so, it's basically trying to say that no mistakes were made and nobody crossed the line. And it's something that the media has been portraying from the beginning. And here's where things take a twist, and highlight this 11.4%. Here's where things take a twist, because I've had people reach out to me saying, listen, what happens now? Where do we stand? This was something that, some people were trying to focus on, the SEC. Now there's no issues and so forth. What's going to happen? Well, let me say this. For the last 9 months, there's been articles after articles after articles written talking about everything poorly about our decision to invest in AMC. And not once did we listen to it. We continue to buy, we continue to hold. And I remember when the heat was on back in March, April, May, the heat was on. And there we were from that $8 to $9 price point, rode that up almost 10x. And then we stabilized, and we're still stabilizing. We stabilized a little bit at 60, back down to 30. We're around that $40 price point now. We're continuing to make a little bit higher supports going forward. But we never listened to anybody because of the research that we've done and all of the DD and all of the ape community that has continued to pass around and unturn every stone to figure out exactly what is happening behind this play still stands. And it still stands today, and it's going to still stand. So while this report was put out, not to, in my opinion, not to kind of say to retail investors, go home, all right, but it was to maintain their validity and credibility in the markets. And there's probably a lot of people that had some questions about what happened that might feel a little bit more secure reading this, whether it's institutions that were not involved, whether it's foreign banks, whatever it might be. That's why this report had to come out. And that's why they took some time and kind of didn't really word this carefully. I feel like you could have went to, how does a stock market work? And they kind of just pulled, things from this, as you can see, a million footnotes. But that's why they wrote this. So if this is swaying any of your decisions, or if you're thinking any which way about it, everything that's been portrayed in the past hasn't changed anything going forward. And this is not going to do the same. So guys, that's my take on it. I'll see you in the next one.